Right, continuing with tax sheltered investments, we're going to talk about education savings accounts. The two of those, one is the Coverdell Education Savings Account. The Coverdell is actually they're they work very much like an IRA. Um, the you make most cases it would be a parent making contributions. I believe Coverdell accounts as a $2,000 a year um, maximum. The uses of money are a little bit broader for Coverdell account than they are um, for a 529 plan, which is the next one we'll talk about. Um, but if you use either of these for allowable expenses, the income is tax exempt. If you withdraw the money and you don't use it for eligible expenses, then you would pay taxes on it. So that's so so we've covered L and then qualified tuition programs are 529 plans, as they're often commonly referred to. Government savings bonds, these would be uh, U.S. Treasury or savings bonds. The income on those is uh, is tax exempt if you use it for education expenses. So, but the downside of government savings bonds is the earnings are typically very low. Tax exempt municipal bonds. Tax exempt municipal bonds are very popular with wealthy individuals because the wealthy individuals are typically in higher tax brackets, and as a result, the benefit associated with that are much greater. Capital gains on housing. They for a married couple, if there's a one-time deduction of up to $500,000 capital gain, $250,000. Um, and, for a single individual, the one requirement is you have to lived in the home at least 2 of the last 5 years. So it couldn't be an investment property. So um, so comparing taxable and after-tax yields. So when we're talking about when we compare, say, a municipal bond to a corporate bond, we have to compare those yields on the same basis, because since the municipal bond is not not taxable, we need to adjust uh, a the corporate bond to reflect that difference. So the after-tax yield is is equal to the taxable yield multiplied by 1 minus your federal marginal tax rate. So the the example here, an individual with a 33% marginal tax rate or 33% tax bracket. So if we had a corporate bond with a 5.7% yield, we would multiply that by 1 minus 0.33, the marginal tax rate, or the 5.7 times 0.67. So the the after-tax yield would be 3.82%. So to think about this, if we were say we had a corporate bond that yielded 5.7% and a municipal bond that we felt was similarly risky. That the one thing we always have to consider when we're talking about investments is risk. So if the risk is the same, then we wouldn't care whether we earned 3.82% on a municipal bond or 5.7% on a corporate bond. If this rate was um, this rate, if the municipal bond yielded more than 3.82%, we would prefer the municipal bond. So, but if the municipal bond was yielding this 3.82% and the corporate bond was yielding more than 5.7%, we would prefer it. So um, other strategies with regard to reducing income, defer income. For one example, there is if you people that work for small companies typically have a little more flexibility with regard to their income. So if your employer's paying bonuses, they might be willing to pay you in January as opposed to December. That would push that tax liability back a year, and it would give you a year to plan for the uh, for that additional income. Accelerate deductions. Most common example is there is to for uh, sell stocks that have accumulated losses. That this is one of the big reasons that the stock market usually declines in December, because investors who have stocks that have lost money during the year tend to sell them so that they can accelerate those deductions. Shift income to a child. Uh, the low that that can be hard. Typically this is something that wealthy people do. Uh, you know, but for you and I, it will probably be pretty hard for our us to switch our salary to our child, for example. But you could do it with investments. Uh, Buy and manage real estate. The real estate or rental properties are one of the most tax advantage items with regard to the Internal Revenue Code. So if the real you have a good rental property, you can make excellent returns on those types of investments. Take all your legal tax deductions. So, um, all right. So We'll finish this lecture and start up with the concept checks and conclude the chapter after